Hey, good morning, everyone. Marty Missouri here. It is the 26th, Thursday of March, 2026. I'm going to keep this one really quick, just kind of in the mood to do a video as opposed to a morning note for you this morning. Although it's further into the morning, it's about 10:30 Pacific time. So I'm just going to kind of talk at you through the top of my head, if you will, this morning about what continues to go on, how the market's responding to it, interesting dynamics in the interest rate markets. In fact, let's just look at that first since I have it up. So this is the beginning of the year Fed funds futures assessment of probabilities. So how traders are trading in the future space, the prospects for a Fed rate cut, or how they were at the beginning of the year. So at the beginning of the year, they had in the neighborhood of 2.5 cuts priced into Fed funds futures, expecting the Fed to actually step in and cut interest rates. Let's fast forward to today, March 26th. And now you can see that the futures market is actually now pricing in some odds of an actual hike in interest rates. So talk about your 180 in terms of Fed fund probabilities. So it's obvious why that's the case. It's because of the war in Iran and its impact on oil prices and the perceived impact of higher oil prices on overall economic inflation. So the assumption here in the futures market is that the Fed, in my view, is actually about to make a mistake, or is leaning towards making a mistake by raising interest rates into an energy supply shock. Why would that be a mistake? Why, if their mandate is to keep inflation under control and higher oil prices are inflationary, why would it be a mistake for them to raise interest rates into a supply shock, into higher oil prices? Well, it's because, very simply, the seriously negative impact of sustained higher oil prices on the rest of the economy, when the consumer is putting a bigger share of their discretionary or disposable income into their gas tank, well, then that clearly is money that's not going to be spent in other areas within the economy, and therefore that lack of demand will actually be a disinflationary or even a deflationary force on those other areas. Raise interest rates into a serious energy supply shock, and you're going to probably have a recession. You're certainly going to have very ugly financial markets, which was kind of the case in 2022 as well. So I personally don't think that they want to do that or are going to make a mistake. I think more likely they're going to hold tight. And this doesn't say that they're going to be hiking aggressively or that that's anticipated, but cuts are off the table. Now, I think I put it in the written blog here the other day that I replied. I don't do this very often, but I was listening to the podcast where the featured guest is somebody I have a great deal of respect for. And that featured guest said, make no mistake, unequivocally, the Fed will never cut interest rates into an energy supply stock under no circumstances, because it's never happened historically. And my comment was, just because it's never happened historically doesn't mean it's going to happen now, particularly when we are now firmly into a global populist setup or a global populist regime. You have to think, I think, firstly and foremostly about the hit to the consumer. Not that cutting rates really helps the consumer. I think we've done a good job of exploring and quantifying that the Fed really has an impact more on financial markets than it does on the real economy. But the wealth effect is so prevalent in this particular setup that we're in now that if financial markets, the equity market, were to come crashing down in a real reflexive sort of way, that could bring on recession like it did in the late 90s, where you really had an economy that was okay, but you had an economy that was too levered to the financial markets and had gone too far, where the actual crash in the tech sector caused a recession. Now, those reflexive recessions, where it's the financial markets that ultimately bring it on, tend to be very mild recessions, by the way. Ugly for the financial markets, but mild recessions. Contrast that with 2008, where the financial markets weren't overpriced, but the consumer was way out over his and her skis with leverage and, the whole mortgage-backed securities and the real estate bubble and all that, that the economy rolled over for economic reasons, if I can say it that way. And it was devastating to the economy, and it was devastating to the equity markets as well. So this one right here, in our view, with a setup that was probably pretty okay, as I've said, when the government is spending at a level that they tend only to spend during deep recessions in the past, probably tough to have a deep recession in that scenario. The OBBBA, the stimulus bill, the big tax refunds and so forth said that the economy is probably going to do okay, but inflation is probably going to be higher than anybody thinks it is. So we've been positioned very, very well for that. At clients, we had a great year last year, and we started out like gangbusters this year before the war, right? So we've given back the lion's share of those gains, still up. In fact, as of yesterday's move, pretty impressively relative to certainly what the stock market's doing. Now, as I speak at you today, the move in our core portfolio pretty much is percentage-wise almost to a T down what the move was up yesterday. It's 83 basis points is what we're down so far today. And so 0.83%. And just to compare that like everybody does, the S&P 500 is down 1.2%. So we're about 0.4% better than the S&P. The NASDAQ is down more than twice that. It's down 1.66% again. So we're doing half as bad as tech stocks are in the U.S. The Dow is down right where we are, about 83 basis points. So in our positioning, though, what's up today makes sense. Our ag exposure, agricultural commodities exposure, is up almost 0.5%. Our nat gas exposure is up 2%. AT&T happens to be up 1%. Our energy ETF that captures the big oil producers is up 2%. Consumer staples is up a little bit. Utilities are up 0.33%, and even healthcare is up 0.2%. U.S. industrial stocks are down almost 2%. U.S. tech stocks, the industry by itself outside of the NASDAQ 100, which is concentrated there, is down over 2%. So quite the hit. Now, we know why, right? So just kind of telling you what I'm sure you already know. As of yesterday, from the White House, we're really close to a deal. We think we've already got it. They want to make a deal. We want to make a deal. All is good. Latest news from this morning and I'm just quoting from a financial headline service we have, Trump, I don't know if I'm willing to work a deal with Iran. And of course, Iran has pushed back, and I said that they were already in yesterday's morning note. Initially, they've gotten the conditions that the U.S. had. They said no. Through Middle Eastern intermediaries, there are talks that are going on. Make no mistake. The headlines are going to be for effect. I know the U.S. really wants to make a deal. I suspect that the Iranian Foreign Ministry really wants to make a deal. The more militant faction in Iran, not so sure about them. So when you go down a layer or two, it is in neither side's best interest for this to be a prolonged, drawn-out affair that keeps ships from flowing through the Strait of Hormuz like they have. That really is the linchpin right there. If you forget about everything else and you just track, which we are, the flow of ships going through the Strait of Hormuz, that is going to be key to financial markets and key to the global economy. Make no mistake, folks, the lack of supply to the world already is somewhat problematic, and that doesn't end the minute 120 ships start going through the Strait of Hormuz, as opposed to the 6 that have gone through, at least as of earlier this morning, because of the impact of the lack of supply so far. So there are price at the pump implications and so on and so forth. At this juncture, I think all of that is quite survivable for the U.S. and the global economy. Really gets called into question if I'm shooting a video like this, a month, 2, 3 months out from now. So from that perspective, you should argue that odds favor a resolution, not necessarily an end to the war per se, but a resolution that allows the flow of ships, essentially energy and other supplies, through the Strait of Hormuz sooner than later. And what we're seeing in the markets and what we're seeing in our portfolio on a day-to-day basis moves virtually exactly like we'd expect it to, given the headlines like I just shared with you. So right now we're inclined not to make any big structural moves in our allocation. We have already made several moves this year. We made several moves before the war. We've made 2 or 3 since then that are actually more, on the largest end, more defensive, on one end, somewhat opportunistic. In our core allocation, we're sitting on quite a bit of, I'm not crazy about the term, but dry powder or liquidity that we can take advantage of things. But right now it's so topsy-turvy, so volatile. We just think we're smarter just to kind of sit back and watch it play out and just keep testing the portfolio and making sure that it's making sense. And so far, so good. So clients, just want you to know that part of it, that we are anything but complacent right here, but also anything but reactionary. But we're going to have to live with the kind of volatility that you haven't had to live with here, the last year and a half or so. Again, I could ramble further for sure. Lots of things that we're looking at. We have lots of tools at our disposal. Let me just quickly touch on 3 charts that you're used to seeing. So from a technical perspective, the S&P has broken down below its 200-day moving average, and it's finding resistance right there. That is not a great sign. You can notice that it's finding support right at this support line that takes us back to August of last year. I drew this line for you, I think, the last time I did a video. We break down below that, and this 200-day moving average begins to roll over. Technically speaking, it's a very ominous sign that we could see quite a bit lower levels here in the S&P. Again, the technicals matter. I mean, we've been doing them for years, and they're helpful. But in this environment, they can also be pretty meaningless. I mean, if we get a resolution, this market's going to blow right through both of these moving averages and right back to all-time highs pretty easily if it's a believable resolution. So I'm sure a lot of traders, I know technicians who I respect, are thinking this is very, very critical. Yeah, technically, sure. But realistically, this could be very short-lived. But of course, all that remains to be seen. And we'll know. This is weeks and months, not years, to play out, at least as it relates to the Strait of Hormuz. As for gold, again, intuitively, people would think that gold should be rocking and rolling because of all the geopolitical risk. I literally just hung up from our morning call within our company, and we talked about this at somewhat length, and that is what's going on with gold right now. Well, you could talk about how well gold has done, like Nick was accurately pointing out, from these levels, obviously this is an opportunity for profit taking and I think that is very valid, and that's part of my own thoughts as well. Also, having lived through this a few times and studied it, and of course Nick's doing that too in terms of the studying of it, gold has a real negative correlation to real interest rates. And typically when you get these, whether it's an energy supply shock or a geopolitical shock that impacts financial markets, gold sells off with other financial markets counterintuitively if you read the textbook. And we talked about this already. Why? Because it's the one good, solid thing that you can get a bid on. And if you're getting margin calls and you have to come up with cash, gold's easy to sell. If you're a central bank that's been buying gold to diversify away from the dollar, and suddenly you need to create some liquidity to fund your country's war effort or what have you, well, then you may have to sell some gold, and that sort of thing will have a negative impact on the price of gold. Ultimately, though, if this continues, gold, I will say, does and will respond positively to the geopolitical risk. But right now, that's not what it's trading on. Yesterday, gold was up like 3 or 4% at one point. You can see that here. Today, gold is giving that back because of the renewed fear that the conflict is not going to be over tomorrow, kind of thing. I extended this line that was consolidation back in here, and right now, that's where gold is finding a little bit of support. This gap will be filled in a hurry, in a resolution scenario based on how gold has been trading of late. And then lastly, just inflation break-evens. This is kind of market gauge compensation for inflation risk, CPI swap rates, and you can see that they're going up. But 2.6% on the 2-year, is not end of the world inflation rates, as you know, but it's the direction that markets are responding to, and this is the 10-year inflation break-even is at 2.45%. This backwardation, if you will, also speaks to expectations longer term versus shorter term. So folks, I promised I'd keep it short, or I think I promised you that. So let me just do a hard stop right there, or I could just ramble all day, and I don't want to do that to you. Appreciate that you're watching and listening, and I'll talk to you soon. Bye-bye.